While Wall Street and crypto initially cheered softer CPI figures, November consumer prices rose 2.7% year over year, below expectations and marking the first such data release since September. Now, core CPI, which excludes food and energy, also came in lower than expected at 2.6%. The report showed shelter and energy costs climbing, while lodging, recreation, and apparel fell. Americans and the Federal Reserve are assessing inflation as well as the labor market. And earlier this morning, New York Fed President Williams saying that some technical factors distorted November CPI reading downward. Well, joining me to weigh in is Sarah Foster, economic analyst at Bankrate. Sarah, good morning, and thank you so much for joining us. Well, first and foremost, these softer inflation figures that were released yesterday and the recent spike in unemployment, what does all of this mean for markets and Americans heading into 2026?
Good morning, Remy. Thank you for having me. I think, we kind of walked away with this personal finance mantra. We often say if it's too good to be true, it probably is. I think that's how you can describe the CPI data. Of course, it has lots of implications for the Fed as far as how they read this moment. When many of these technical factors, the agency, it's unprecedented for them to have to cancel in October or any monthly print. They go through this process where they carry forward prices from the month before, which is essentially, a method that assumes that prices didn't increase at all in the month. That's going to be really challenging for the Fed to kind of read this inflation moment, especially when you look at some of those more stubborn measures that have been really sticky over the past few years, and particularly rent prices. Assuming that rents didn't increase at all in a month, looking at the 2-month average, it was about 0.13%. That really is something that's pretty unrealistic in the broad sense. And if indeed rents did increase by that slow of a pace, it's something that we haven't really seen since the 2008 housing bust. So it's going to be really challenging. And I think the big message right now is that, the government reopening, it hasn't necessarily fixed the issue here of all of us flying blind with economic data. And it's probably going to take several more months for the Fed, for policymakers, for economists, and of course for markets to really know what's happening in those inflation numbers.
And of course, for Americans out there who are dealing with higher costs, and economists also warning of distortions in the latest figures, what are you expecting to see when it comes to loans, mortgages, as well as everyday costs like rent, food, or gas?
It's a good question. Something that we've been tracking for several years now, since 2018. You mentioned the consumer. We found that many Americans are actually feeling the most pessimistic about the outlook since we've been polling in 2018. Just about a third of them say that a third of them expect that their finances will worsen. And it's actually the share of those who think their finances will get better has fallen by 10 points over the past 12 months. I think that kind of gets at this big question where even say, disinflation was as strong as it looked in November, it's a question of will we take the good for exchange with the bad? We heard from Fed Governor Christopher Waller, who is a potential Fed chair candidate. He said this week that the Fed can certainly bring prices down, but people would probably not like the outcome because of the economic pain that requires. I think lower interest rates, as we're probably expecting, the Fed will gradually continue to cut rates next year. If it's on the side of the labor market weakening, not because of good news cuts with inflation slowing, that brings about its own economic challenges as well, with many Americans maybe not feeling confident about taking on more financial risk. No matter how cheap borrowing costs are, they might not be interested in locking themselves down into a big ticket purchase like a home or even a car when we continue to see that those prices hit records. So I think the big question is be careful what you wish for. And I think especially as we think about disinflation, about the cooling in the labor market that we've seen, and the price that you might have to pay for those cheaper borrowing costs, the reason for those cuts matter.
And finally, before I let you go, it is not just the Federal Reserve that pays attention to economic data. It's also businesses and investors that make decisions. So in the short term, are there specific sectors like housing or retail where data distortions might be more significant?
Yeah, well, another kind of piece that we haven't talked about yet where data distortions are still prevalent, and even for reasons beyond the government shutdown, is the labor market data. A really eye-opening piece from Fed Chair Jerome Powell at the last Fed meeting of the year. He talked about how those BLS annual benchmark revisions, the pace at which they've been taking jobs away from the economy has led many Fed officials to think that some 60,000 jobs per month are being, overestimated. And at this pace, they are probably expecting that the economy is losing some 20,000 jobs per month. Now, of course, this is really illustrating that difficult place that the Fed finds itself in, with inflation still being above target, but with the labor market also slowing. They're trying to determine whether the labor market is slowing because of, low supply, stricter immigration, an aging population, or whether it's slowing because of labor demand. And I think the reason why the shutdown is so difficult is because it already makes forecasting, it exacerbates the forecasting challenges that many Fed officials face, where these important labor market metrics, no matter how good they are and how, robustly they are prepared, they're always going to be subject to revision down the line.
Okay, Sarah, well, we will have to leave it there, but thank you so much for joining us, and thank you so much for sharing all of your insights and perspective.
Thank you for having me, Remy.